All right, let's get going. So I want to thank everybody for joining us so far for today's home buying seminar. And hang on a second. So I'm just going to run through the agenda real quick as to what we're going to cover today. Both you'll have myself, I'm Dmitriy Banar. I am the VP of Mortgage Operations here at the Credit Union. And we have Patrick or Rick Capobianco, who is our loan officer. We're going to cover, roles of realtors and attorneys, what they do, what they offer, what they bring to the table. We're going to talk about the pre-approval qualification process, shopping for a home, what we offer, the entire loan process, the pre-qualification process. And I'll try to give you guys a little bit of an insight as to interest rate trends, what's going on in the market, and where we stand. So Rick is our loan officer. He's been in the business for over 30 years now. He has managed a team of loan originators. He's seen pretty much every single type of transaction you can think of, scenario. He got it covered. I've been in the business for about 18 years myself, and I've done pretty much every aspect of mortgage lending. So between the two of us, you have some industry veterans that we can answer your questions and hopefully give you guys some education on the process. So you're more educated and confident and know how everything works. And anything that we don't answer, you can always reach out to us for any one-on-one sessions or questions you may have. Also, we do have a Q&A available as well and a chat. So if you have any questions throughout the presentation, just type them in and we'll either save them to the end or address them as they come in. So we'll get going. The first thing I just want to cover is some key terminology because it's important information to know throughout the rest of the presentation. So I'm going to run through this. And again, there's a lot of information on the screen, but I'll try to be as concise and quick as possible. So the first thing is, what's a credit score or a FICO? And a credit score is a numeric number that's assigned to everybody by the credit bureaus. And what it does, it gives lenders like us information as to your willingness and ability to repay any loans or debt or mortgages that you take out. The higher the score, that means the more qualified of a borrower you are and the better interest rate and terms that you can qualify for on any type of loan that you apply for. And it doesn't apply just to mortgages. It applies to consumer loans like car loans, personal loans, credit cards, any type of loan or credit that you get. Obviously, the higher the score, the better the terms that you get. As far as mortgage qualifying goes, we pull all three credit bureaus, Experian, Equifax, and TransUnion, and we use the middle score out of those three as your qualifying credit score. The next is a ratio called your debt to income ratio, and it's one of the most important ratios that any lender will look at to see how much you qualify for on a mortgage. What the debt to income ratio or DTI consists of is we take all of your monthly liabilities or debts that you pay out that are reported on your credit report. So your minimum payments on your credit cards, your car loan payments, your mortgage payment, any student loans, personal loans, pretty much anything on your credit report, we add up those monthly payments and we divide that by your gross monthly qualifying income. And that gives us your debt to income ratio or your DTI. And obviously, the lower the DTI, the better, because that means you fully qualify for the loan. Most lenders want you to be no higher than about 43% on that ratio. Anything above that, it really does limit what you can qualify for and how much you can qualify for. Next one is called the loan to value ratio or LTV. And that is another important ratio that every single lender does look at to determine the maximum amount of a mortgage that you can be approved for. And that's a simple calculation. We just take your loan amount that you're applying for, and we divide that by the purchase price or the appraised value of the property. And as long as that ratio is at 80% or lower, you do not need to obtain PMI or private mortgage insurance, which is on the bottom right of the screen right here. So you can put less than 20% down, but in order to do that, you have to pay an additional monthly payment to us or the lender, which protects the lender in the case you default on your loan. Because the less money you put down, the riskier of a loan or a mortgage it is in the lender's eyes, and that's why that PMI or private mortgage is required. Now, PMI doesn't necessarily have to be for the life of the loan. There are instances where it does cancel automatically once you make a number of payments on your mortgage. But usually, if you can put 20% or more down, that's going to qualify you for the better terms that are available as far as interest rates and mortgage terms. Points is a very frequent thing that we get asked about. What is a point? How do they work? And what's their purpose? So a point in general is 1%. 1 point is 1% of the loan amount that you're borrowing. And a point is an additional one-time fee that you pay as part of your closing costs, and it allows you to get a lower interest rate than what is generally available without paying any points. To determine if paying points makes sense, that's a calculation that Rick or myself or any loan officer will go over with you. And in essence, what you want to look at is how much money you're going to save on a monthly basis by obtaining the lower rate. And what is the cost of that point? Is, for example, on a $250,000 loan, 1 point is $2,500. So if that $2,500 that you spend now is going to save you $100 a month by reducing your interest rate, that means it's going to take you about 25 months to recuperate that initial investment that you made into buying down the rate. Now, and that, when does that make sense? It really depends on what your long-term plans and goals are and how long you think you're going to be in the property and how long you're going to be holding on to the mortgage for. So it's something that you will discuss with your loan officer, see if it makes sense based on your goals, your plans, and then you can make a decision to either buy the points and buy the rate down or not. And the last important term on here is the annual percentage rate, or the APR. And what the APR is, it's not the actual interest rate. So there's kind of two rates, the actual interest rate and the APR. The APR takes into account the closing costs that are paid for obtaining the mortgage. And it allows consumers such as yourself to really shop different mortgages or quotes or offers that you get from different lenders. So if you'll say you're getting a mortgage from lender A and the APR is 6.5%, and lender B, same mortgage, same loan amount, same term or length of the loan, and the APR is 7%, that means the lender with the higher APR has more closing costs associated with obtaining that mortgage. So it really does allow you to compare your options on a very quick and a high level basis. With that said, some lenders don't include all closing costs or only certain ones in the APR. So while it's a good metric to use, I wouldn't rely on that for your sole decision. So Rick, I'll have you go through this slide. This is our just keys to success on a very high level. And some of these things we are going to go into a little more detail further in the presentation. So Rick, all yours.
Very good. Thanks again, everyone, for joining us tonight. We appreciate it. So this page is just an outline of what we're going to get into for the rest of the seminar here. We're going to go over how to get qualified, how to, when to, and the function of that, and we can even show you at the end where to go on our website to get pre-approved. So the application comes right to me, and we can work together on that. So pretty simple process. We'll talk about how to find a realtor. It's important to have a good realtor, and they can be a little difficult to find. So we'll guide you the best way we can on that. And of course, that leads to finding the home and working with the realtor, and even my role in working with your realtor as well. Part of finding the home is getting it inspected. We may touch on that later on in the maybe towards the end, but inspections are back in style, so to speak. There was a point in time you may have heard your friends or family buying houses and having to waive the inspection. Realtors would use that as a bargaining chip, so to speak, to say, hey, these people will not have a home inspection, so that may be the better offer to take, in a competitive situation. Not the best, not the greatest way to do business. Some buyers will just turn away and say, I'm not even going to deal with it. I'll just go to another property. But we can touch on that either towards the end or on one-on-one. But just safe to say that inspections are back in style. I'm seeing probably 30% of the transactions we get now are pending a home inspection. So that's good. That's a good thing to see. Retaining an attorney, important part of the process. Could be the most important part if you run into some issues. So, which is very, very, very rare. But in that rare event, it's good to have a really good attorney. We have some we recommend, we highly recommend, and we can get into that later on in the seminar. And also, maybe referrals to you know, not so much put a lot of weight on. If you're being referred to an attorney from the same person you're buying the house with, the same salesperson, you may want to separate those interests. So we can talk about that. That leads to purchase and sale agreement. You find the house, you have the home inspection, your attorney has reviewed your purchase agreement. It's an important contract, and we'll go over the details of that contract, items that you need to fulfill, and ways to avoid losing money up to and including your complete deposit, which leads to securing financing. Securing financing is, everyone waits for that day, right? That everything's done. I'm finished. I'm fully approved. The property's been inspected. The property's been appraised. The bank looks at it. Bank says it's fine. The condition's fine. Everything's done. That's your financing commitment. And we'll talk about what that looks like and the importance of getting that on time. And if it doesn't come in time for any reason, we can talk about that as well. And then finally to the closing. So, seven simple steps to the closing, and we'll go over those one at a time on the next slides coming up.
Great. Thanks, Rick. Yeah, just one thing I want to mention about home inspections and what the importance of them is usually when you go out and shop for a home, you see it once, either at open house or one time with a realtor. You spend half hour, 45 minutes in the property. You really are not going to get another chance too often to go back and look at the property before you got to put an offer in on it. So you put your offer in on a $500,000, $600,000, $700,000, $800,000 property investment that you're going to be purchasing, and you've only seen it once, maybe twice for a half hour, 45 minutes. You don't really know the ins and outs of what kind of shape the place is in, unless you're a building inspector or a contractor and you're an expert in these things, it's hard to tell. So the home inspection is a very important piece because that's a professional who's licensed, who is going to look at every nook and cranny in the property, and they're going to give you a detailed report of everything that they find. And it's actually a great negotiating tool as well. If the issues come up and they're nothing major that scares you away, that you can work with your realtor, as long as you have a good one, to maybe either get some credits or concessions on the purchase price and to have it work in your favor. Or it could be used as a tool to completely cancel and back out of the contract. So that's why, in the past when they were being waived, it was pretty scary, but I'm glad to see they're coming back around because I truly feel they're a very important piece for everyone to get, to protect yourself, to know, hey, is the foundation crumbling? Is there any major structural issues? Some people might try to push you to waive it. I would never personally waive a home inspection on a huge investment that I would be making. So Rick, I'm going to talk about some of the key partners and their roles. I'll handle the real estate agents, and then Rick can talk about attorneys and then what he does as well. So as far as real estate agents, there's usually two of them to a transaction. There's one called a seller's agent and one's a buyer's agent. And one, as you can probably guess, represents the seller. One represents the interest of you as the buyer. They both do have a fiduciary responsibility to have your best interests in mind, but that's why it's also important to do your due diligence and to get some references or recommendations as to the real estate agent you're going to be working with. They should be an expert in their field. They should know the location where you're looking, the ins and outs, and what the market is. They will assist you in buying or selling your property. And they're also going to draft and deliver some of the important documents that need to be prepared that are part of the home buying process. One is an offer to purchase. Another one is a purchase and sales agreement. They'll also help you to negotiate and try to get the best deal possible for you. They'll also perform a real estate market analysis and tell you, hey, the seller's trying to get $900,000 for this property. It's only really worth, I think, $800 or $700. So they really do offer a good service, but it's important to have a good one. And like I said, check with friends, family. We have recommendations, but definitely check and make sure they're a huge and important piece of the process, and you want to make sure you have a good one. Rick, if you want to take off.
Yep. So from that point on, when we start working at the pre-approval stage, and this is nice when this comes up at this stage, before you even start looking, even before you find a real estate agent, I can recommend or connect you with some attorneys that we have. It's great to have even just a few emails back and forth, a light introduction. Because what happens with the attorney is a very important part. They're going to help you review your purchase agreement with you. It's a legal document. Once you sign it, certain things are binding, and you may have certain risks or protections in that document. So it's important to understand it. And this is something that your attorney is going to review with you. I recommend at the time of pre-approval, get your attorney lined up. Just have a brief introduction through email. Hey, I'm going to be buying a house soon. Say hello. Then when it happens, you can recall that person. Hey, I just made an offer. It was accepted. And the first thing that happens as soon as you have an accepted offer, 2 seconds later, the realtor is going to ask, "Who's your attorney? Who's your attorney?" We need to get them all the documents. So everything kind of happens in really quick at that point. So it's nice to have this lined up. We can talk about that at the time of pre-approval.
Want to add to that, Rick, I'm sorry for interrupting. One thing, all these attorneys, they don't charge you anything up front. They will work with you, and they'll collect their cost at the time of close.
Yeah. So the attorney that we have, will also, and again, this is in maybe 3 different states. So we have Maine covered, New Hampshire, Massachusetts, and Rhode Island. We can refer attorneys that we know. And that attorney can also do the closing for you. So it's a great partnership to have an attorney on your side, and then we can also assign the closing to them. And it's nice just to have that relationship ahead of time. And like Dmitriy said, you save the dual legal fees where you've hired an attorney to watch your back, review your documentation, and then there's another attorney doing the mortgage closing. You might as well get the benefit of wrapping that all up. So we can help you with that. Very important. Anytime you need a referral, just give me a call. And even if you're not pre-approved yet, that's fine. And then that leads to our function. Like Dmitry was saying, the lender and the loan officer. When I worked with a whole team of loan officers, I think we all agreed at one point that about 5% of what we do is actually talk about the mortgage. And the process and closing costs and the rate, and that's all fine. And the other 90% is really, assisting with the transaction. And that can mean a lot of different things. Sometimes maybe the appraisal comes in a little bit lower than the purchase price. How do you handle that? Maybe you're having trouble with a certain type of document that you're trying to find. So maybe we find solutions around that. Maybe the seller starts getting a little strange with things, and maybe you have a seller credit or towards some repairs, and maybe the repairs aren't being made on time. So even though the realtor technically is there to help with these things, a lot of it falls back on us, and we're glad to do it, and I think we do and most of the time even a better job than maybe some of the realtors, just because of the exposure we have to hundreds and thousands of transactions. We can untangle these things pretty well. So again, a very small percentage of transactions have issues. We always point these hypothetical issues out on these classes, but in reality, I'd say, I don't know, 8 out of 10, 9 out of 10 close smoothly, no trouble at all. And when you do hit that occasional snag, 10% of the time, we're here to help, and we're here to fix things. So that's really the function of the lender and the loan officer at a bank like this, at a credit union like this.
Yeah, the only thing I want to add, Rick, and I 100% agree with what you said. Obviously, one of the most important things that we do is we'll guide you through the process. We'll answer questions that you have. We'll come up with different scenarios, different options. Hey, is a 15-year mortgage better than a 30-year? Should I take an adjustable rate versus a fixed? We have the knowledge. We will guide you. We'll give you the options, and we'll educate you so that you are prepared and you can make this best decision that's for you based on the information that we can give to you. So next is the pre-qualification and pre-approval process. And just before Rick takes over, one thing I just want to mention, the term pre-qualification or pre-approval, they're interchangeable. They mean one and the same thing. Some people may harp, no, I need a pre-approval. It's the same thing as a pre-qualification. So just so everyone's aware.
Yeah. And just a note on that, because it's worthy to pick up on that just a little bit. If you deal with a realtor that's been in the business for over 20 years, back in the day, 25 years ago, there was a term pre-qualification. And before, credit reports were easily accessible. I mean, we can literally run a credit report in 35 seconds now, but it used to be a big deal. And what some lenders would do is a pre-qualification. And it was basically it was based on your information. How much do you make? You have good credit? Okay, fine. Here's a qualification, just based on the math, but really not secured by any documentation. So that term used to be not such a great thing. Now, these days, I mean, for the past, 15, 20 years anyway, we run instant credit reports. We verify information. We ask you for certain things, and vet out the real important questions, your employment history, where do you work, are you self-employed, and all that. And I put that on the letter. So the letter that we prepare, that I prepare, besides having the MIT logo, which I think is kind of impressive, especially in this market now. We have a lot of these internet lenders that no one ever even heard of. You have text right on the top of the letter, and it specifically says, I verified your income, your employment, and your credit. That carries a lot of weight. So you call it what you want, but it's really about the most vetting you can possibly do before you buy a house. So it's a good letter, it's a solid letter, and a solid process, I should say. So, and part of that is, I can determine your maximum qualifying amount, but ultimately we're going to talk about the amount and the monthly payment that results in that amount. And, you have to be comfortable with it. I think these days lenders are still probably on the very generous side of pre-approving you. I mean, like Dmitriy was saying, 45% of your income. If you think of 43% of your gross income, that's a lot of your net. If you only take home about 75% of your gross, and 40% of your gross is being used for your maximum housing, that's a big chunk. So you may be okay with that. You may be comfortable. That may fit your plans. Maybe you're not. So that's something that we talk about. We run the numbers. So when you make an offer, and maybe it goes a little bit over what you imagine, exactly what the monthly expense is going to be for this property with taxes and insurance. We can make some pretty good estimates up front. Very important, but it's nice when you make that offer, exactly what you're going to be paying. So determining your maximum loan amount, like you said, it's up to you. And I'm sure that our calculation will fit into that, probably be over what you want. And that, again, falls into a review of your credit, your income, and your assets. They all play a role in that maximum figure that we can come up with. So again, just the next few slides talks about, realistic and affordable amounts. That's in most cases for you to decide. So I think the good news is that we will probably come up with a number that's more than what you would want to spend. So that's a good thing. So you can back it down and fit your lifestyle. Maybe you have childcare expenses. We don't take a lot of those into account. Most lenders don't. Heating the house, electricity. Maybe you have 2 cars or 3 cars or boats and planes and trains and all that stuff there. So, everyone has a different lifestyle, and you want to fit this amount within your lifestyle so that we can talk about that. And then finally, I put it in a nice letter. Like we said, it's in writing. It's very often changed. So as you're out there moving around and looking at different values, we can change that really, really quick for you. And another big question that comes up is, how long is the qualification letter good for? There's a real answer to that, but my answer, because you're on the street and you're giving these to realtors and you're using them to make offers, I'd say don't let it go more than 60 days old. It's good for longer than that in theory, but if you're carrying around a 3-month-old pre-approval letter, it may be frowned upon by certain lenders. So if a couple months goes by, you still haven't secured a property, give me a call. I'll freshen the date on it, ask you some questions, make sure it's still valid. And so you always have a nice fresh letter to work with.
Absolutely. I fully agree. The only thing I want to add, getting pre-qualified or pre-approved, it's no cost, no obligation. It's the most important first step in this process that you should take, is speak with us to find out where you stand, what you qualify for, what the payments are going to look like, so that you're prepared. We want to educate. We want to educate you so you have all the right tools and the knowledge to be able to make the best decision for yourself. And like Rick had said, you know, we look at gross amounts, but realistically, you're playing with net amounts. So we'll look at your budget, we'll advise you, and then it's up to you to make the decision. So let's continue on to the next slide. So offer to purchase. This is, you found the place, you've talked to your realtor, you have your pre-qualification letter, you found the place that you love, now it's time to make an offer. So you're submitting a written offer to the selling side, to the selling realtor, and it's pretty much to listing the terms of what you are going to offer for the property. It's, like I said, it's a critical step. It's prepared by a real estate agent, and it does serve as a legal proposal and initiates the process of the real estate transaction. Now, just by submitting the offer doesn't mean that you're 100% on the hook and you can't back out. So just keep that in mind. But it does outline the terms and conditions under which you as the buyer is willing to purchase the property. So let's say you want to ask the seller for a $5,000 credit towards closing costs, or you know, you want them to do some kind of repairs based on the home inspection that you may have already gotten or that you noticed on yourself, when you viewed the property. Obviously, it's going to include details such as the purchase price, down payment, or also called the earnest money deposit, your financing terms, and any other relevant conditions. Now, what financing terms are an important thing to note is because there are certain types of mortgages that are frowned upon by sellers versus other kind. So a federal FHA loan, Federal Housing Authority loans, are usually tougher to get done. So most sellers don't like to see those. VA loans are also tougher. So the type of loan and terms that you're applying with can sometimes make a difference. And also the offer is going to include some contingencies that must be met, such as a financing contingency, getting a home inspection, an appraisal contingency. So you want to make sure that the property at least appraises for the price that you're offering. And also it sets important dates, like I said, such as the financing date and the closing date. And the financing date is the date in the purchase agreement that says that you have to notify the selling side that your mortgage is 100% approved. There's nothing additional needed from you to satisfy any conditions that the lender may require before the loan is allowed to close. That is kind of the last date in the purchase process that you potentially can back out of the entire agreement and be entitled to get your deposits that you've put down back. So very important dates that go into this offer. And after the offer is submitted, hopefully you hear fairly soon that your offer has been accepted. Offer is accepted, then you move on to the purchase and sales agreement stage of the process. And I'll let Rick go through this one.
Sure. So in not every state, some of you may be buying in other states, but not every state has a two-step process. We changed screens there?
No, I'm sorry.
Yep. There we go. So not every state, but Massachusetts has a two-step process. So you're going to make an offer. Your offer will be accepted verbally for a very short period of time. It was submitted in writing, of course. And then you'll hear, hey, it's been accepted. And then you'll have your first step, which is the offer to purchase. And then within the offer to purchase, it will identify a date of purchase and sale agreement. And then you go on to your purchase and sale agreement, which is really just a more detailed version of your offer to purchase, right? So it shouldn't vary that much as far as, a closing date, certainly not the purchase price. So most of the important steps in the offer should directly translate into the purchase and sale agreement. Of course, you may have some inspection items at that point in time in the purchase and sale agreement, but pretty much just a more detailed version. And again, very, very important dates on the purchase and sale agreement is the financing commitment. It's a legally binding contract. You are given, I shouldn't say given, you should be aware of your protection on a financing contingency date. It's a date that you need to secure financing. Just like we were saying with home inspections, there was a time where they were being waived. Well, there was also a very big point of time, probably an 8-year period of time, where I was doing a lot of business like in Belmont and Lexington, where even the financing contingency was waived. So if you didn't get financing, first of all, you had to buy the house with no inspection. And then if you didn't get your financing, you also lose your deposit. So it wasn't the best, it wasn't the most buyer-friendly time. Things have changed a little bit in the sense that we see almost every purchase now, I'd say in the last 3 or 4 months, has a financing contingency in it. And again, that means not so much that you know, we change our mind about your credit score, things like that, but there's a lot of things that go into an approval, and one of them is the home itself. You know, maybe the value comes in light, or the you know, the condition is an issue. Again, very, very rare. But maybe something changed in your personal life where you know, again, something happens during the process, financing is unable to be obtained. You have that date to raise the flag and say, I cannot obtain financing for this property, and you get all your money back. Very important thing. You'll be talking to your realtor about that. I'm sorry, your attorney about that. That's a financing commitment. There'll be obligations. There'll be obligations in there that maybe the seller has to repair something before the closing, or replace something before the closing. Very common. And you know, we assist in that as well. If it's an important item, maybe, for example, the furnace is being replaced, or a major repair item is being done, it may get to the point where we actually have our appraiser go back out and verify, not only for us, but for you, that it's been done properly, a proper permit's been pulled in case it's a permit related issue. So, you know, if you have a repair item, again, a plumbing, electrical, or gas line, something like that, it's not only done, but it's done right, and it's done per code, and you're not going to have problems with that. So we assist in things like that. Those things are usually also put in the purchase agreement and a condition of the closing. So you don't get a call 3 days before the closing and say, oh, by the way, I haven't had a chance to replace that burner, but don't worry, I'll give you some money at the closing. Those things don't happen. You're all protected with the language in the purchase agreement. So the transfer doesn't take place before that happens. Protect you against an earnest money deposit, just the last item there. Again, a couple of protection points in the purchase agreement. That's why it's good to have an attorney ahead of time. You review this document, review your protections or lack of, and you know, whatever you're comfortable doing at the time of, you know, your offer. And you can review these with your attorneys, and you can also review with us as well. But your attorney is the best line of defense when it comes to language in the purchase and sale agreement.
Great explanation, Rick. Thank you. So the mortgage loan process, let's talk about this in a little bit more detail. It's somewhat similar to the pre-qualification or pre-approval process, but at this point you have submitted your offer's been accepted, the attorney's prepared the purchase and sales agreement, you've executed the purchase and sales agreement, and now at this point you've notified your lender, Rick or myself, and say, hey Rick, I've got my offer accepted, my purchase agreement is signed, I'm ready to go full steam ahead. That's when the actual mortgage loan process begins. And that begins with you either submitting an updated application if necessary, or just letting us know what the purchase price is and the property address of the property that you're purchasing. Once we have those two important pieces of information, that's when the actual loan is live, meaning we've collected all the information we needed from you to get to you your initial disclosures. You'll also need to submit your updated income and assets and credit documentations as necessary, because documents are only good for generally about 90 to 120 days before they're expired and they have to be refreshed. Once you submit your income, asset, credit documents and your loan application submitted as well, within 3 business days of that happening, you're going to get from us your initial mortgage loan application disclosure package. And one of the most important documents in there is the loan estimate. The loan estimate is going to give you the rate that you have applied for or that you're qualified for, the closing costs, your monthly mortgage payment, if any PMI is required, what the monthly homeowners insurance is going to cost, and what the monthly property taxes are going to cost. Now, it's important to hold on to that loan estimate, because when you get to the end of the process, which we'll get to on the slide, is comparing that to the closing disclosure. But we'll get to that in 1 second. So you've got your loan estimate and disclosures, you submitted all your income and credit documents. At this point, what happens is your loan gets submitted for underwriting review. Underwriter's job is to go through everything with a fine-tooth comb. That is their job. They're going to look at you. They're going to scrutinize your income. They're going to do your income calculation. They're going to review your bank statements. They're going to see if there's any outliers or large deposits that may need to be addressed. They're going to see if, you truly qualify for the property and the loan amount that you've applied for. If after the review, everything looks good, what is issued is the loan approval and the commitment letter. The commitment letter, that's the document that is used and provided to your attorney and your real estate agent to satisfy that mortgage financing or contingency date. Once that commitment letter is issued and you've given it to the attorney, real estate agent, and they've given it to the seller side, there's no backing out of the transaction. So that's, as Rick mentioned in the previous slide, it's a very important date and a very, very important part of the loan process. Now, a lot of times what happens is, like I said, the underwriter's job is to look through everything with a magnifying glass. So the commitment letter and approval, they're usually conditional. And what that means is the underwriter says, you know what, everything looks great, but we need an additional bank statement to show additional funds that are needed for closing. Or, I'm going to need one more pay stub before closing because the documents are going to expire. Or we need an explanation for X, Y, and Z. Whatever those conditions are, they're part of this loan approval and commitment letter. At that point, what's going to do is your loan processor, who's going to be part of this whole loan process with you, they're going to reach out to you and say, hey, Rick, congratulations, your loan's been approved, and I'm going to send out your commitment letter. In order to get your loan ready for closing, we need to get X, Y, and Z from you. You're going to work with the loan processor and upload those needed documents to our portal, which is 100% secure. And the loan processor is going to then send it back to the loan underwriter for them to review what you've provided and clear those conditions. And what we strive to do is to clear all the outstanding conditions before your financing date comes so that we can issue you an updated commitment letter showing that you are 100% and fully approved. Now, once in a while, you'll have to go through this process, this step maybe once or twice, because maybe some of the documentation you give to us may cause additional questions or the need for additional items that might be needed. So just be prepared. Once in a while, it can happen a couple of times where we'll come back to you and say, hey, based on the review of what you've provided to us so far, we need to get X, Y, and Z. The most important piece that I would say is communication is very important, and we'll communicate to you right away what is needed and why it's needed, but also for you to provide those documents to us in a timely manner. Because if you wait and don't send them to us, we can't clear the condition. We can't give you a clean commitment letter, or we cannot clear your file to close. So that's this bottom left-hand side is the additional required documentation that's provided to you from you to us as outlined in the commitment letter. Now, once everything is in, we submit your loan back to the underwriter for a final review. The underwriter says, great, everything's good to go. Your loan is clear to close. That's at that point where we notify you, your real estate agent, and your attorney saying, hey, we are ready to schedule the closing. At that point, that is when we will prepare this closing disclosure. Now, the closing disclosure is going to have all the final costs for all the closing costs down to the exact penny and tell you your final amount that you have to bring to closing to complete the transaction. And that's why I said it's important to hold on to that loan estimate, because it allows you to do a comparison. Hey, this is what you guys told me it's going to cost me up front. Closing disclosure is now showing this. Let's talk about the discrepancy. Now, our loan estimates, again, they are an estimate, but we try to be as complete as possible. Now, sometimes the attorney that you select or choose may charge a little bit more or a little bit less than what we estimated it's going to be. So we'll go through all those things, answer questions, make sure you understand everything. And the other important thing to keep in mind is you're going to get this closing disclosure from us no later than at least 3 business days before the closing date. So it gives you ample time to review it, ask questions, and for us to answer any questions that you may have. Then at that point, you attend the closing, and we'll talk about that in a slide. I believe might be the next slide or the slide after. Now, I just want to address one question that was put in the questions. I just want to answer it live. And the question was, if we're working with the same pre-qual letter for 60 plus days and we need to do a refresh, does that credit get repulled? And if so, is that second hard hit in a short period of time? Great question. We get it all the time. So it depends. Credit reports are good for 120 days. So if we need to give you a refreshed a commitment letter, I'm sorry, pre-approval or pre-qualification letter, and it's before that credit report is expired, we will not need to pull a new credit report. And you're not going to get a second inquiry, hard inquiry on your credit report. Now, with that said, one of the things that we are starting to do is for the pre-qualification process is we're going to be doing soft credit checks, meaning it's not going to be a hard credit pull on your credit report. So, and the only time we'll actually pull a hard credit check is when your offer gets accepted and you're ready to truly go to step one over here, which is submitting your loan application. Hopefully that answered your question. All right. Next slide. Closing. Rick, I'll let you take this one, this fun one.
All right. What to bring to the closing? A big pile of cash. So, and we'll get to that too, because you know, the biggest question, you know, about a week before closing is, you know, how much do I have to bring? What's the exact amount? So the nice thing about the closing is, and it's true, I think, for the whole transaction. You don't have to, you know, the number one thing I see people get nervous about is, what should I be doing? What do I need to do? What should I be doing? What's next? The nice thing about the mortgage process is we guide you through the entire process. So you never need to worry about what you need to be doing, what you should be doing. You know where you need to be, what to bring, when to be there. You're going to know everything. So don't worry about next steps, because we guide you through those steps. But obviously an important thing is closing. You don't want to miss that. It's a pretty important day. And like Dmitriy was saying, you know, 3 days before the closing, you're going to get a complete outline of exactly what you're going to see at the closing. It wasn't long ago that you would see all these documents and all these numbers at the closing. That would be the first time. I think Dmitriy's just old enough to remember that, when you'd go to a closing as a buyer, and that's the first time you saw how much everything was costing, the final figures. And it wasn't great. It wasn't a real borrower friendly environment. That changed a long time ago, and now you're going to see all these numbers 3 days in advance. I can tell you there's almost never discrepancies or mistakes, but if there is, you know, we have a day or two to fix them or talk about them, right? So that's the nice part about closing. You know everything there is to know about it 3 days in advance, including how much to bring to the closing. The closing attorney will work with you on how to get the money there, whether it's a wire transfer or a bank check. That's the easy stuff. Again, you'll be guided between us and the attorney on how to get the money there and how much needs to get there at least 3 or 4 days before the closing. And like Dmitriy was saying, you know, the loan estimate you have a day or two after you apply. So again, none of this is ever going to be a surprise to you. What may be surprising is, I think in most cases, the actual is either equal to or a little bit less than the estimate, because the estimate we do is everything's on the high side. You know, everything's pretty much on the high side. And you may fall into that where everything's on the high side. And in that case, it was fairly accurate, but most are a little bit less. So you're going to bring your identification there. Again, the attorney will tell you what documentation and you know what to bring to the closing. What happens at that point, depending on the time of day, you know, your transaction, your actual ownership may be recorded that day. So the registry of deeds is just like the registry of motor vehicles, so to say, right? So you buy a car and you have a title. Same thing with the house. You buy it and it gets recorded at the registry, and that may happen the very same day. Now, I've seen some cases where if you close late on a Friday, like 5 o'clock on a Friday, there may not be time to record, and sometimes there's, you know, a question about, do you move in on Saturday morning or is it Monday? You know, maybe worth mentioning if you happen to fall into that category, but typically they're either recorded that day or the very next morning, and that's technically when you legally own the property, and your attorney will you know, confirm that with you. If you close in the morning, for example, you'll probably be on record by 2 o'clock in the afternoon. So it's usually not a big deal. Stack of documents. Again, the documents that you're going to sign at the closing, none of them should look new to you. You've probably seen them all before, but it's a final rundown of the exact figures and the exact taxes that you're paying and all that there to the city and town, and that's what you're going to see at the closing. So again, the same documents that you've seen through the process, but just final versions of them. And that's the closing.
Yep. The great points, Rick. The only thing I would suggest is like how you mentioned, the ownership of the property doesn't transfer until it's recorded at the registry of deeds. So you always want to schedule your purchase closing for earlier in the day than later in the day, because that allows ample time for the attorney to either electronically record or run down to the registry and get it recorded, because they will not give you your keys until it's on record. Until it's on record at the registry of deeds, the transaction is not 100% official. So just want my piece of advice: if you're buying, schedule your closing for as early in the day as possible. All right, favorite topic of mine, and I'm sure everybody's, interest rate trends and what's going on in the market. So I'm sure everyone has seen in the news how over the past couple of years, interest rates have shot up dramatically. And that's because the Fed is trying to fight inflation, and that's their number one goal. And because that's one of the biggest tools they have in their toolbox is to raise rates. So things become more, lending and borrowing becomes more expensive. So people spend less money on discretionary items. With that said, rates are extremely volatile. They go up and down. Sometimes I've seen them move up in a single day by more than a quarter or, a half a percentage point. And we are somewhat in a rising interest rate environment. They do go through the ebbs and flows, and the ebbs and flows happen on a weekly basis. So my advice is, and it's a funny little saying, you marry the house, but you date the rate. Meaning, whatever the rates are, lock it in and protect yourself. Whatever interest rate lock does, it protects you from rates going up and you being, on the short end of the stick when rates increase. The rate lock protects you. There is a downside to a rate lock. If rates drop, you've locked it in. You can't really, a lot of times, say, oh, I saw the rates dropped, I want the lower rate. Unfortunately, it doesn't really work that way all the time. There are some instances where we can work with you and potentially reduce the rate. But again, my advice is always, if you're comfortable with the rate, comfortable with the payment, and you don't want to gamble and risk the rates going up on you before closing, lock it in and be protected. When rates fall back down, which we're all hoping and expecting them to happen over the next 2 to 3 years, you can do something called a refinance, which you take out a new mortgage, it pays off your current mortgage and at the lower rate, and then now you have a lower interest rate. So the market is that volatile because there are economic news that comes out on a daily basis that drive the market and drive what interest rates do. A couple of years ago, you asked me, what do you think rates are going to be? I could give you a pretty good prediction. These days, it's a coin flip. That's why I always say, if you're comfortable and you're ready, lock in. If we can help you and drop your rate sometime before closing, we absolutely will, but it's just not possible all the time. Just to give you an idea as to what we offer and what we do. So we do, as a credit union, we do lend nationwide. So it doesn't matter what state you're in, no matter what type of property you're buying, in primary residence, vacation or second home, investment properties, we can do it all. And we do quite a few loans all across the nation. We have for fixed rate options and we have adjustable rate mortgage options. Now, adjustable rate mortgages are not in style, I want to say, these days anymore, because a lot of lenders don't really offer them, or if they do, the rates are significantly higher than what's available on a fixed rate mortgage. But at times, an ARM or an adjustable rate mortgage may be beneficial to you. We offer terms between 10 and 30 years. Like I said, we offer them on owner-occupied homes, second homes, investment properties. So an investment property is a property that you're going to buy and rent out, and it could be 1 to 4 units. Anything above 4 units, it's no longer considered a residential loan, or mortgage cannot be applied to it. And we do have some very low down payment options, as little as 3% down. We do have some down payment assistance options. And we also have some options where we can actually help and pay for some of your closing costs with a lender credit. And those are all things that either Rick or myself or a good loan officer will review with you and answer questions and educate you, right? We're all about educating here, educate you so you can make the best decision that's best for your long-term plans and goals. So hopefully, I know there was a couple of questions that came in. If we do outside of New England, hopefully they're answered. Yes, we do. And we do lend in Maryland. We've done quite a few loans. And the next question was, how soon after closing does the buyer need to occupy the property? It is within 60 days. 60 days, if you're doing an owner-occupied loan, you have to occupy the property within the first 60 days. So that covers our presentation. Hopefully it's been educational and beneficial for you. Our contact information is here. Everyone is going to get an email from that attended with our information, links to our mortgage center. You can see it on the bottom left-hand side of the screen here as well. We have a lot of great tools and information on our website. A lot of FAQs, a lot of frequently asked questions. We post our rates so you know what you're working with, what we can offer. We have great mortgage calculators, and like I said, we're here to guide you and help you and educate you and answer your questions so that you can be prepared and make the best financial decision that's for you. The last thing we want to do is put you into a property that's unaffordable, because we would hate for you to lose the place and ruin your credit and have all those bad things happen. So thank you, everybody. I appreciate you guys joining and taking the time. Any other questions, don't hesitate to reach out to any of us. And yeah, we will have a recording of this presentation available. So once that is ready, we'll send a link to everybody as well. Thanks, everybody. We do have a few more minutes. I can hang on the line. If some more questions come up, I'll be more than happy to answer them. If not, we'll call it a day, and hope everyone has a great evening.
Now, I will end with, everyone has our contact. Feel free, even tomorrow. You think of a question later on tonight, shoot me an email and we can talk live anytime.
Great. All right. Looks like no more questions are rolling in. So thank you, everybody, again. It was a pleasure. Anything you need, don't hesitate. And hope everyone has a great rest of your day.
Okay. Thanks, everyone.